Millions do it and still report the wrong balance every month, not because they overspend, but because they're paying on the wrong date. That date is the statement closing date, not the due date. It feeds roughly 30% of your FICO score. If you don't know when it falls, your on-time payments aren't doing what you think. You keep your balance somewhere reasonable. You do what every piece of credit advice says to do. Your credit utilization still shows up higher than it should, and your score still won't push past the ceiling you've been watching. That's not bad credit behavior. That's a timing problem. Card issuers report your balance to the credit bureaus on the statement closing date, not when you paid, not on the due date. That snapshot goes to Experian, Equifax, and TransUnion. It becomes your reported utilization. That figure goes directly into your FICO score. Many borrowers with elevated utilization are leaving dozens of potential points on the table every month. Not from missed payments, from paying on the wrong date. By the end of this, you'll know the exact date to target, what balance to have sitting there when it arrives, and why 3 consecutive billing cycles is the timeline that locks the improvement in. There's also something specific about how the reporting sequence actually works that almost nobody who covers this topic explains correctly. That's the part that changes what you do next. We're getting there. One mistake most people make after learning this actually cancels the benefit. I'll show you. Think about how you actually handle your credit card each month. You get a statement or a notification. You see a due date. You pay before that date because that's what responsible looks like. Your payment history stays clean. No late fees, no penalty APR. You assume your credit score reflects the discipline you've been putting in. It doesn't work the way you think it does. Here's what actually happens. Your card issuer closes your billing cycle on the statement closing date. That day, or within 1 to 2 business days, they send your current balance to the 3 major bureaus. That becomes your utilization for the month. By the time the due date arrives, the snapshot has already been sent. There's a window between the statement closing date and the due date, typically 2 to 4 weeks. Pay down before the close and a low number gets reported. Pay after, which is what most people do, and the full cycle balance is already in the files. Let me put a number on this. Say your credit limit is $5,000. You spend $2,800 over the course of the month. The statement closes on the 15th. You pay it in full on the 20th. Before the due date, on time, perfect payment history. What gets reported to the bureaus? $2,800. Your utilization on that card, 56%. Most lenders want that number below 30%. Some underwriting models flag anything above 10%. You paid in full. It's still reported 56%. The scoring algorithm scored you on the 15th, not the 20th. That's not a flaw. That's the system working exactly as designed. Whether it works in your favor depends entirely on whether you know when the snapshot happens. This is one of the most common score ceilings I see, someone doing everything right, hitting a number they can't explain, and the answer almost always comes back to the statement closing date. If you have more than one credit card, each one has its own statement closing date. Each one reports independently. Each one takes its own snapshot on its own schedule throughout the month. Your total reported utilization isn't a single calculation taken at one moment. It's a composite of multiple separate snapshots, each carrying whatever balance was sitting there when that card closed. One card caught with a high balance on its specific closing date drags your per-card utilization up independently from everything else. FICO 8 scores per-card utilization as well as total utilization. Both numbers matter. Most people only ever think about the total. The due date protects your payment history. The closing date controls the score. What I'm about to show you in the next 90 seconds is the part most people never find. Don't stop here. This is the one that changes what you do next. Your credit score is built from a snapshot. Every billing cycle on the statement closing date, your card issuer sends your current balance to the credit bureaus. The bureaus update your credit file. A scoring model recalculates your score from the updated data. FICO 8 is still the most widely used, but lenders can choose from 49 different FICO versions depending on what they're evaluating. Every version reads that utilization snapshot. The reported balance isn't an average of the month. It isn't the highest balance you reached during the cycle. It's the balance on the statement closing date specifically. That one day. If your balance peaks at $4,200 on the 10th and you bring it down to $280 by the 15th, and the 15th is your statement closing date, $280 is what gets reported. Not $4,200, not an average. $280, that's 5.6% utilization on a $5,000 card. Here's the specific number to absorb. This is the part that makes people rewind. Dropping your reported utilization from 55% down to 8% in a single billing cycle can move your FICO 8 score somewhere between 40 and 90 points, depending on your credit profile. Not over 6 months, not by opening new accounts, in one billing cycle. Because utilization isn't a history metric. It resets. Every single month, it resets from whatever balance the closing date snapshot captured. 40 to 90 points, one cycle. That's more movement than many people see in an entire year. That range reflects how FICO has described the utilization component in its own documentation. It varies by profile, but for someone sitting at a 680 with clean payment history and elevated utilization, this is often the only lever that needs to move. When you have multiple cards, the math compounds in a specific way. FICO 8 scores you on 2 utilization levels simultaneously: your total utilization across all your revolving credit and your per card utilization on each individual account. Both affect your score. A $1,800 balance on a $2,000 limit card is 90% per card utilization, even if your other 3 cards are empty and your total utilization across everything looks like 18%. That one card's per card number is working against you regardless of what the aggregate shows. Here's how that plays out in practice. You're managing 4 cards. You're monitoring total balance. Everything looks manageable from that angle. But the card you use most, the one you run most of your spending through, is also the one hitting the highest per card utilization on its closing date every month. I ran through this with someone who had been stuck at the same score for almost a year. 4 cards. One of them sitting at high per card utilization every single month at its close. Total utilization looked acceptable. Per card on that one account, a consistent drag. Single timing adjustment. Score moved in the next cycle. What surprises most people at that point is the timeline. Credit advice is built around patience, 6 months, a track record, negative marks aging off. That timeline applies to payment history. Utilization doesn't work that way. The reported utilization resets with every closing date snapshot, which means a meaningful balance change shows up in your score the following month, not 6 months later. The next cycle. The system was designed to give lenders a reliable picture of how you use your revolving credit. That picture is taken on a schedule. The schedule is in your card agreement, on your statement, and visible in your account portal. It's not hidden. It just isn't explained in a way that connects the date directly to the score. A $300,000 mortgage over 30 years. The interest rate you qualify for is directly tied to the credit score the lender pulls. A 60-point score gap typically means a full percentage point difference in rate or more depending on the lender and market. On a $300,000 loan over 30 years, a single percentage point works out to tens of thousands of dollars in additional interest. That's not a rounding error. That's a car. That's years of retirement contributions paid to a lender because the score at application time sat 60 points lower than it could have. The 60-point gap between 680 and 740 is exactly the kind of gap that closing date awareness closes for people with otherwise clean credit files. No new accounts, no disputes, no credit repair required. It's not only mortgages. Auto loan rates vary by 2 to 3% across credit tiers. Personal loan rates vary more. Credit card APR can be adjusted upward when issuers conduct periodic reviews on existing accounts. Apartment applications where a landlord pulls your score. Insurance premiums in 47 states that use credit-based scoring for auto and home policies. Every one of these reflects a snapshot taken on the statement closing date. A lender pulling your score on the 16th sees a completely different version of you than one pulling it on the 14th. In most of those states, the insurer doesn't notify you that your credit score affected your premium. You pay the rate. You don't connect it to the balance on your card when the policy renewed. Same timing error. A different financial product. The same invisible cost. I've tracked enough of these conversations to know that most people assume the jump from 680 to 740 requires a long stretch of perfect behavior. For a lot of people with clean payment files, it turns out to be 1 or 2 billing cycles of closing date adjustments. The bottleneck is rarely where people think it is. Here's the specific window I mentioned at the start. This is the part that makes the whole thing operational. Your statement closing date isn't a hard wall where everything locks at midnight. Card issuers typically transmit balance data to the bureaus within 1 to 3 business days after the statement closes. But you need your payment to be fully posted and reflected in your balance before the close itself, not before the transmission date, before the close. A payment you initiate on the closing date may not post in time depending on your payment method and your issuer's processing schedule. The window is 4 business days before your statement closing date. Not 4 days before the due date, 4 business days before the closing date. That's when you want your target balance sitting in the account, cleared and reflected. That's what changes the snapshot the bureaus receive. Now you understand something most people who've managed credit for a decade haven't precisely put together. Not because they weren't paying attention, because the due date and the statement closing date get treated interchangeably in most standard credit advice, and the practical gap between them, in score points, in rate terms, in dollar terms, almost never gets this specific. Here's exactly what to do. Step by step. Nothing vague. Step 1. Find your statement closing date on every credit card you carry. Log into each card's account portal. Look for statement date, closing date, billing cycle closes, or statement closing date. It's in the account summary, the billing section, or at the top of your most recent statement. In Chase, it appears in the account overview labeled closing date. In the Amex app, check under statements. In Capital One, look in account details. Labels vary, the date is always there. Write down the closing date for every card. Those are the dates that control your credit score. Step 2, set a target balance per card. Below 10% of your credit limit per card is the range that consistently produces the strongest score response in FICO 8, and in most scoring models, lenders commonly pull. On a $5,000 limit, that's $500 or less. On a $2,000 limit, that's $200 or less. This isn't the balance you never exceed during the month. It's the number you want sitting there when the statement closes. Step 3, set a calendar reminder 4 business days before each statement closing date. Not before the due date. Before the closing date. On that day, check your balance, calculate the gap between where you are and your target, and make a payment to close that gap. Confirm it posts and clears before the closing date, not just that you initiated it. Debit payments and bank transfers typically post within 1 to 2 business days. Verify your card's specific processing timeline before you rely on that estimate. Step 4, find the most recently reported balance on each card. Most apps show this in the account overview. Some require you to check the last statement. Divide the reported balance by your credit limit. That's your per card utilization. Any card above 30% is your first priority in the next cycle. Step 5, run this for 3 full billing cycles before you judge the results. Utilization changes can show up quickly because the metric resets monthly, but 3 cycles of consistent low balances at the close will stabilize the improvement. By cycle 3, your reported numbers will reflect your intended pattern and your score will follow. No new accounts, no credit repair, no disputes, a timing adjustment applied on a calendar. The first time I walked someone through this process, what surprised them most wasn't the point movement. It was how simple the calendar part actually is. One reminder, 4 business days before the close. That's the whole operational piece. One more piece of this because it reframes how you think about credit going forward. The statement closing date mechanic isn't a one-time correction. It's a structural shift in how you understand what the credit system actually reads. Most credit advice is built around the due date framework. Pay on time, don't miss payments, keep your balance manageable. That advice isn't wrong. It describes the floor. What we covered today describes the ceiling. Payment history and credit utilization together account for 65% of your FICO score. Payment history guidance has been everywhere since the first card you opened. The utilization mechanics, how the balance is captured, when it's transmitted, what number ends up in the bureau's files, those aren't part of the standard conversation most people ever have about credit. The statement closing date is what makes that 30% of your score something you actively control rather than something that just happens to you each billing cycle. There's a spending habit that compounds this. Make larger purchases right after your statement closes. You've got the full billing cycle to bring the balance down before the next snapshot. Keep things lower in the days approaching the close so the reported number reflects your actual credit discipline, not a mid-cycle spike that cleared days later. You're not spending less. You're spending on a schedule that makes the snapshot match what you intend. In a system that runs on monthly snapshots, timing is the lever you control most directly. If you've been watching your score and wondering why it won't move past a number that doesn't match what you're doing, that's the answer. Most people know the due date. Almost nobody knows the closing date. One protects your payment history. The other controls the score lenders actually see. Before today, did you know your statement closing date? Yes or no? Drop it in the comments. I read all of them. If this gave you something real you didn't have before, subscribe. There's a lot more of this coming. Next, I'm breaking down what happens to your credit score when you close a card you've had for years and why the calculation most people make on that decision turns out to be wrong. It connects directly to what we covered today. The numbers will surprise you more than these did.